Listen, tell your wife you'll do the dishes later. If you have to go to the bathroom, bring your phone with you and lock the door. Because what I'm about to reveal about the institutional panic happening on Wall Street trading floors right now is so urgent that everything else in your life just became secondary. We need to talk about the phone calls, and I need you to lock in for the next 10 minutes. For the last 48 hours, my inbox has been flooded. I'm getting reports from private wealth clients, from high net worth individuals in London and New York, and even from regular retail traders who hold significant positions in their brokerage accounts. And the story is the same in every single email. They are telling me that their brokers are proactively reaching out to them. Now, if you have been in this game for a long time, you know that brokers usually only call you for two reasons: to sell you a fee-heavy product you don't need, or to margin call you when you're broke. They do not call you to give you free winning advice. But suddenly, this week, the phones are ringing off the hook. Ladies and gentlemen, Asian guy here known as John A.G. from Currency Archive. We are hearing specific names floating around the rumor mill, and the script they are reading from is identical. It is coordinated. It is precise. They are calling clients who have held silver through the dark years, clients who bought at $20, who held through $30, and who are sitting on massive gains at $80. And they are telling them the party is over. You need to get out. But they aren't just telling them to take profits. That would be normal. They are going a step further. They're actively recommending that aggressive clients consider initiating short positions. They are pitching put options. They are pitching inverse ETFs. They are telling their own clients to bet against the strongest bull market in a generation. In the language they are using, it is designed to terrify you. They are not saying we expect a pullback. They're using words like meltdown. They're using phrases like structural liquidity event. They're telling grandmothers and retirees that a massive unavoidable crash is guaranteed to hit the silver market in the next 72 hours, and that if they don't sell everything right now, they are going to wake up poor. They are painting a picture of a catastrophic flush that will wash away all the gains of 2025 in a single afternoon. Now, I want you to pause for a second, step back from the fear, take a deep breath, and think like a detective. Ask yourself the most important question in finance. Cui bono? Who benefits? Since when do the big bullion banks care about your financial well-being? Since when do they proactively call you to help you time the exact top of a market so you can maximize your wealth? They didn't call you when silver was at $18 and tell you it was the buying opportunity of a lifetime. They were silent. In fact, they were publishing reports saying it would go to $15. They didn't call you when it broke $50. But now that silver is at $80 and ripping higher, now that the COMEX is being drained and the Shanghai spread is blowing out, suddenly they are your best friends. Suddenly they are deeply concerned about your downside risk exposure. Absolutely not. This is a trap. They are not calling to save you. They are calling to save themselves. They are frantically trying to manufacture sellers because they are desperate for buyers. You have to realize that for every seller, there must be a buyer. If they are telling everyone to sell who is planning to buy, they are trying to create a wave of retail panic selling to provide the liquidity they need to exit their own toxic short positions. They are trapped in a burning building and they are trying to convince you to run into the fire so they can use your body to smother the flames. They are likely short 4 billion ounces of a metal that is disappearing from the vaults. Every single dollar the price goes up costs them billions in margin calls. They are bleeding out, and the only way they can stop the bleeding is to trick you into folding your hand. They need you to sell your winning lottery ticket for pennies on the dollar so they can cover their shorts before the real explosion happens. And the weapon they have chosen for this psychological operation, the boogeyman they are using to scare you out of your position, is a technical bureaucratic event that most people have never even heard of. They are pointing to a calendar event called the BCI Rebalancing. They are holding up this rebalancing event like a loaded gun, claiming it will trigger a $6 billion dump that the market simply cannot absorb. They are telling you that this is the catalyst that ends the bull run. But is this really a meltdown, or is it the most sophisticated bear trap we've seen in decades? To understand the lie, you first have to understand the kernel of truth they are hiding it inside, because the BCI is real, but the narrative is a complete fabrication. To dismantle this lie, we have to start by looking at the weapon they are holding. We have to understand the specific mechanism they are using to terrify the market, because it is not a ghost story. It is a real structural gear in the global financial machine. We need to talk about the Bloomberg Commodity Index, or the BCI. Now, to the average person, this sounds like boring financial jargon. It sounds like just another ticker symbol scrolling across the bottom of CNBC. But to the big money, to the sovereign wealth funds in Norway, the pension funds in California, and the university endowments at Harvard and Yale, the BCI is not just an index. It is the Bible. It is the grandfather of all commodity investment vehicles. It is a massive passive algorithmic beast that manages roughly $18 billion in assets. Think about the scale of that number. $108 billion. This is money that doesn't think, it doesn't analyze charts, it doesn't watch the news. It doesn't care about supply shortages in Mexico or solar panel demand in China. It is blind capital. It simply tracks a basket of commodities according to a strict set of rules written by mathematicians in New York. Because it is a passive robot, it follows a rigid calendar. It doesn't wake up one day and decide to sell silver because it feels bearish. It only moves when its programming tells it to move. And the most important line of code in its entire software is the January rebalance. But every year, in the first weeks of January, this $108 billion robot has to perform a maintenance check. It has to look at its portfolio, which holds everything from crude oil to soybeans to coffee to gold to silver. And it has to adjust the weightings of every single slice of the pie. It has to make sure that the amount of money it has in each commodity matches the target weights that were decided upon for the new year. It is a purely mechanical process. It is automatic. It is unavoidable. And this is the fact, the undeniable bureaucratic fact that the brokers are screaming about on the phone. They are screaming because the targets have changed. For the year 2026, the governing committee of the index has decreed that silver's target weight must be cut. They have decided to lower the exposure. Technically speaking, the target weight for silver is dropping from roughly 49%, which was the target for last year, down to a new target of roughly 94%. On the surface, this looks like a straightforward sell order. The brokers are pointing at this document and shouting, "Look, the robot is programmed to sell. The biggest whale in the commodity market is dumping its position. You have to sell before the robot does." They are framing this as a vote of no confidence in silver. They are framing it as a fundamental rejection of the metal. But that is the deception. The robot isn't selling because silver is bad. The robot is selling because silver was too good. The index has rules. It has caps. It is not allowed to let any single commodity become too dominant. And because silver performed so spectacularly well in 2025, because it outperformed almost every other asset on Earth, it grew too big for the basket. It started taking up too much space. So the rules say it must be trimmed, it must be pruned back to size. It is the penalty of success. But the brokers aren't telling you that. They're telling you that a meltdown is coming. They are telling you that this mechanical adjustment is going to trigger a cascade of selling that will break the back of the bull market. They are using this dry administrative rule change as a psychological weapon to induce panic. And to make the fear stick, they are throwing around massive dollar figures. They are whispering that because the fund is so huge, 18 billion, even a tiny adjustment in the percentage points translates into a mountain of cash. They are saying, if this massive fund starts dumping who is going to catch the falling knife, it will crush the bid stack. It will wipe out the order book. This is the narrative they have constructed. It is built on a foundation of truth. The rebalance is real. The selling is mandatory. But the conclusion they are drawing that this equals a crash is a lie built on bad math. And this is where we catch them red-handed, because if you actually sit down and do the calculations, if you actually look at the numbers they are trying to hide from you, you realize that the scale of the selling isn't just big. It is actually much, much bigger than the nothing Burger Crowd thinks, but it is also completely misunderstood. There's a specific mathematical error floating around social media right now. You might have seen it on Twitter or Reddit. People are saying, oh, the target is only dropping from 4, 5 to 3, 9. That is a difference of 0, 5%. That is tiny. It's only $600 million. Why is everyone panicking? And the brokers love this. They love that you're confused, because the people saying it is only 600 million are wrong. And the brokers claiming it is a meltdown are lying about the impact. We need to clear the fog of war. We need to do the real math right now together on the screen. We need to calculate exactly how many ounces are about to hit the market, because the number is not 600 million, it is 10 times that size. And once you see the real number, you will understand why the banks are so desperate to get you to sell. Let's look at the real math. Let's look at the $6 billion reality. You cannot simply look at the target from last year and subtract the target for this year and think you have solved the puzzle. That is rookie math. That is first grade subtraction. And in the brutal world of high-frequency commodities trading, that kind of lazy thinking gets you slaughtered. The people on social media who are telling you, relax, it is only a 0.5% adjustment, are missing the most critical variable in the entire equation. They are forgetting about price action. They are forgetting what silver actually did in 2025. Think about it. When the year started, silver was sitting quietly in the basket, taking up its assigned slice of the pie. But then the rally began. Silver didn't just go up a little bit, it exploded. It went from $30 to $40, then to $60, then to $80, and more than doubled in value in a single calendar year. Now imagine you have a pie chart of assets. If one slice of that pie doubles in size while the other slices like oil and corn and wheat stay relatively flat or go down, what happens to the pie? The winning slice expands. It takes over. It starts pushing everything else off the plate. By the time we hit December 2025, silver wasn't taking up 5% of the BCI fund anymore. It had swollen like a balloon. The effective weighting of silver in the fund had ballooned to nearly 9% of the total assets under management. So when the rebalancing robot wakes up in January, it doesn't just look at the old target. It looks at the current reality. It sees that silver is currently hogging 9% of the room, but the rulebook says it is only allowed to have 94%. Do the math on that spread. The robot doesn't have to sell 5%. It has to sell the difference between 9% and 94%. It has to dump roughly 5% of the entire $18 billion fund. It has to amputate half of its silver position to get back in line with the rules. Now, let's put a dollar sign on that because this is the number that the brokers are whispering to scare their clients. Take $18 billion, calculate 5% of that. You're looking at a sell order of roughly $4 billion to $6 billion. $6 billion. That is not a nothing burger. That is a Leviathan. If you convert that into paper contracts at current prices, you're talking about roughly 70 to 78 million ounces of silver that need to be puked out by this index in a very short window of time. That is almost 10% of the entire annual global mining production being sold in a matter of days. This is why the brokers sound so confident on the phone. They aren't lying about the volume. They have the spreadsheet right in front of them. They see this $6 billion wave crashing under the order book. And they are telling you, look, it's mathematical suicide to stand in front of this train. You have to short it. They are using this massive, undeniable number to convince you that the price must collapse. They are betting that the market structure is too fragile to handle a 70 million ounce sale. And if you only looked at this one number, if you only looked at the sell side of the ledger, you would agree with them. You would panic, you would sell. But this is where the trap closes. Because in financial markets, volume is not the same thing as impact. Just because someone has to sell $6 billion worth of stuff doesn't mean the price has to crash today. It depends on when they sell it, and it depends on who knows they are going to sell it. And this is the secret that JP Morgan and Morgan Stanley are hiding from you. They are pretending that this $6 billion sell order is a surprise. They are pretending that it is hitting the market right now, this week, all at once. But is it? Does a fund manager with a $100 billion wait until the last minute to execute the biggest trade of the year? Or do they play a different game? We need to expose the timeline. We need to look at the concept of front running. We need to explain why this crash is already in the rearview mirror. You have to ask yourself a very simple question about market mechanics. If you knew with 100% mathematical certainty that a massive whale was going to sell a huge amount of silver in January, would you wait until January to react? If you were a shark at Goldman Sachs or a hedge fund manager at Citadel and you saw the BCI announcement back in October 2025, would you sit on your hands for 3 months? Would you wait for the price to potentially drop before you exited your position? Absolutely not. In the professional trading world, waiting is synonymous with losing. The moment that report was published in October, the moment the target weight was cut to 94%, the smart money started moving. They started front-running the trade. This is the dirty little secret of the index game. The BCI is not a surprise party. It is the most telegraphed punch in financial history. Everyone knows it is coming. Everyone knows the size, everyone knows the date. So the active managers, the guys who run the funds that track the index but have the freedom to trade around it, they didn't wait for this week. They spent November selling into strength. They spent December selling into the rally. They slowly, methodically offloaded that $6 billion of exposure while the price was ripping higher. They used the liquidity of the bull market to hide their exit. They were feeding the ducks while the ducks were quacking. So by the time we actually get to January 8th, 2026, by the time the brokers are calling you on the phone, screaming meltdown, the vast majority of that selling pressure has already happened. It has already been absorbed. The reason silver didn't go to $100 in December, the reason it paused and consolidated around $80 was precisely because this selling was taking place in the background. The market has already eaten the $6 billion meal. It is digesting it right now. What is left for this week? What is left for the so-called crash? Only the dumb money? Only the strict passive ETFs like the iShares Commodity Trust or the DJP fund? These are the funds that are legally prohibited from trading early. They must trade on their rebalance date. But these funds are tiny compared to the whole. They represent maybe 2 billion or 3 billion of the total. They are the tail of the dog, not the dog itself. And this reveals the true nature of the broker's call. If JP Morgan knows that the smart money sold in December and they know that only the passive robots are selling today, why are they telling you to short now? Because they want you to sell the bottom. They want you to look at the selling from the passive robots, which might push the price down $1 or $2 for a few hours and mistake it for the beginning of the end. They want you to panic, dump your shares into a market that is already priced in the event. They're trying to get you to provide liquidity to the very same active managers who are now looking to buy back in. Think about the cycle. The active managers sold in December at $85. Now the passive robots sell at $75. The active managers are sitting there with cash, waiting to buy those cheap shares back from the robots and from you to ride the next leg up. The brokers are helping them close the loop. They are recruiting you to be the victim in a game of musical chairs that ended 10 minutes ago. This is why I call it a hoax. The volume is real. Yes, $6 billion was sold, but the timing is the lie and the impact is in the past, not the future. We're looking at a rear view, mirror event. And while the West is obsessing over this paper shuffle, while New York traders are sweating over basis points and rebalancing dates, there's a force in the East that couldn't care less about the Bloomberg Commodity Index. There is a buyer who doesn't use algorithms. There's a buyer who uses ships. And this buyer is looking at this dip not as a panic event, but as a clearance sale. We need to pivot to the bullish reality. We need to talk about the China shield. We need to explain why every single ounce that the BCI robots vomit onto the market is being instantly swallowed by a dragon. Let's look at the arbitrage. Let's look at why the dump is destined to fail. And this is where the bank's plan falls apart completely. This is where their sophisticated paper game crashes headfirst into the brick wall of physical reality. Because while the algorithms in New York are obsessing over target weights and rebalancing dates, there is a monster in the East that is eating everything in sight. We have to talk about the China shield. We have to talk about the single most important number in the global silver market right now, which is not the price you see on your screen. It is the difference between the price on your screen and the price in Shanghai. Right now, as we speak, the Shanghai Gold Exchange, the physical hub where metal actually changes hands in China, is trading at a massive premium over the COMEX in New York. We are seeing a spread of nearly $7 an ounce. Do you understand the physics of what that means? It means that a bar of silver is worth $7 more the moment it crosses the Pacific Ocean. It is an arbitrageur's dream. It is free money. If you can buy silver in New York for $75 and sell it in Shanghai for $80, you don't just do it once. You do it 1,000,000 times. You do it until the vault is empty. Now think about what the BCI rebalancing actually does in this environment. The robot comes in and dumps $6 billion of paper onto the New York market. This temporary selling pressure pushes the COMEX price down. Let's say they manage to push it down from $80 to $72. The brokers cheer. The shorts celebrate. They think they have won. But what have they actually done? They haven't destroyed demand. They have just put the metal on sale by pushing the New York price down while the Shanghai price stays high. They have just widened the arbitrage spread from $7 to $15. They have just turned a profitable trade into the trade of the century. They have effectively subsidized the Chinese accumulation of silver. Every single time the price dips in New York, the vacuum cleaner in the East turns on full blast. The arbitrage traders, the global banks, the commodity houses, the Chinese state-owned enterprises, they look at that $72 price tag and they scream buy. They scoop up every ounce that the Buey robot sells. They take delivery, they load it onto ships, and they send it to China. The dump that the brokers are warning you about is actually a gift to Beijing. It accelerates the drain. It speeds up the very shortage that drives the price higher in the long run. The BCI is literally transferring wealth from Western pension funds who are forced to sell low to the Chinese government, who's happy to buy low. And why is China buying so aggressively? Why is there a physical floor under the market that refuses to break? Because China isn't trading for a quarterly bonus. They are trading for survival. They control 80% of the global solar panel manufacturing capacity. They know that without silver, they cannot build the solar panels. Without solar panels, they cannot achieve energy independence. They're looking at the same geological maps we are. They see the mine supply shrinking. So when they see a rebalancing event, when they see the foolish Westerners selling silver because a rule book told them to, they don't panic. They laugh, and then they buy. This is the China shield. R. It is a massive, impenetrable wall of buy orders, sitting just below the current price. It ensures that any dip caused by this rebalancing will be shallow and it will be short-lived. You cannot crash a market when the biggest buyer in the world is standing there with an open checkbook praying for a discount. So if you listen to your broker, if you short the market right now, you're not betting against a bubble. You are stepping in front of a freight train called the People's Republic of China. You're betting that a paper algorithm in New York is more powerful than the industrial demand of the world's second largest economy. That is a suicide bet. The banks know this. JP Morgan knows the spread exists. They are probably the ones trading it. But they need you to be the liquidity on the other side. They need you to be the SI who sells your physical or your ETF shares so they can cover their shorts before the inevitable snapback occurs. They are using the rebalancing narrative as a smoke OKC screen to hide the fact that they are terrified of the East. They know that once this $6 billion selling window closes, there's no more inventory coming. The passive funds will be empty, but the Chinese demand will still be there. And that is when the real fireworks begin. That is when the price stops reacting to New York and starts reacting to Shanghai. So, we have exposed the broker hoax, we have debunked the math, we have revealed the front running, and we have identified the buyer of last resort. What is the final verdict? What should you do when that phone rings? We need to wrap this up with the conclusion. We need to give you the final marching orders for this week. Let's finish this exposure. Let's tell the banks exactly where they can shove their meltdown. You have to remember the single most important statistic in this entire saga, the number that keeps the risk managers at JP Morgan awake at night sweating through their sheets. They are short 4 billion ounces of silver. They sold promises they cannot keep. They sold metal they do not have. And now with the price ripping through $80 and inventories disappearing, they are staring into the abyss of a default. They need a miracle. And the BCI rebalancing is the only miracle they have left. It is the only scheduled event on the calendar that guarantees a wave of selling pressure. It is their one and only chance to create a smoke OKC screen. They are using this event to generate enough noise, enough fear, and enough confusion to cover their tracks while they try to exit their positions. They are hoping that if they scream meltdown loud enough, you will panic. They are hoping that you will look at a red candle on a chart triggered by a mindless robot in New York and mistake it for the end of the world. They need you to be the liquidity. They need your shares. They need your contracts. They need your physical bars because if you don't sell to them, they have to buy from China at $90 or $100. They're begging you for a bailout. So here is my final instruction to you for the week of January 8th, 2026. When that phone rings and you see the name of your brokerage firm on the caller ID, when they start reading from that script about downside protection and rebalancing risks, hang up. Do not engage. Do not debate. And certainly do not sell. Do not let them talk you out of the only asset that is effectively immune to the debt collapse of the Western world. Do not trade your sovereign wealth for their dying paper promises. You have to have the discipline to look past the next 48 hours. The rebalancing window is closing. The robot is almost done selling. The dumb money is almost done panicking. And once that selling pressure lifts, which is a matter of days, not weeks, the weight is gone, the beach ball is released, the price will not just recover, it will snap back with a violence that will shock the shorts. We are looking at a slingshot maneuver that takes us straight through $85 and opens the road to triple digits. The fundamental drivers haven't changed. The mines are still empty. The solar panels are still being built. The dollar is still dying. The only thing that changed was a line of code in a Bloomberg index, and that line of code is irrelevant to the laws of supply and demand. This is a game of chicken. The banks are revving their engines, flashing their lights, and driving straight at you, hoping you will flinch. But their car is made of paper, and your tank is made of silver. If you hold the line, they crash. If you hold the line, the 4 billion ounce short position blows up. This is not just a trade anymore. It is a transfer of wealth. It is the wealth of the manipulators flowing into the hands of the stubborn. Be stubborn. Be the immovable object. Do not be the victim of the meltdown hoax. Be the beneficiary of the rebalancing sale. If they push the price down to $75, thank them and then buy more. Because in 6 months, when we are trading at $150, you won't remember the BCI. You will only remember that you didn't let them steal your future. This is John A.G. The hoax is dead. The target is locked. Remember to like, subscribe, and share. See you on the other side.